going on at a macro level, particularly with a focus on the US and how that's influencing investment decisions? And are there any potential upside here? Will Loebis-Arnost is the Senior Investment Analyst at Activam. He joins us again. Will, welcome back to AusBiz. So what are you watching? What numbers are you watching out of the US that's perhaps going to determine just how investable it is at this point?
So Andrew, we watch both the hard and soft data that's been released out of the US recently. So in particular, US GDP growth contracted by about 0.5% in Q1 this year, weakest reading since 2022. But at the same time, the DXY, the US dollar index, is down 8.5% year to date. But on the positive note, job openings was up 7.8 million, above expectations 7.3 million, and sentiment was revised higher, 60.7 from prelim 60.5. Not a euphoric number, but still a positive. But despite all this, we've seen the mega cap rallies leading to the all-time highs of the S&P and the Nasdaq recently. So above all that, it seems to us that there's been a confluence of different data coming through. But despite all that, there's still been quite a bit of a rally.
Well, indeed, and back to record levels. Yet,
Indeed.
Will, there would appear to be still quite a bit of cash on the sidelines. What would be the catalyst to actually deploy that cash, do you think?
I think for a lot of institutions, there seems to need to be more certainty regarding when to actually enter the market. Just looking at the data, there's about 4 trillion institutional money in the US still being invested in money market funds, and only about 2.5 trillion from the retail side. So I guess amongst all institutions, both in Australia and the US, a lack of certainty regarding current geopolitical tensions, how the tariffs going to start to affect inflation in the US is also a contributing factor of why there's still so much money on the sidelines.
And we're back to where we began in terms of that rally as driven by the mega cap tech stocks. So it is fairly narrow. Should that be of concern, perhaps that it is not a broader rally?
I guess it is slightly concerning that that there's a small number of stocks that's literally driving up two of the key indices higher. But we don't see this as a major issue. We see this as the fact that these companies are quite positive earners. Forward consensus and earnings are positive for most of these Mag 7 companies, with the exception of Tesla, that is. And that's with the theme of AI now starting to really generate some traction. These companies now getting even more momentum. And so we don't see it as a massive issue. What we see is a potential opportunity, because what it means is we can potentially be in a positive growth environment.
Now, how beyond the States, how are you looking at emerging markets at the moment?
Yeah, so emerging markets relative to, in terms of valuation, relative to developed markets, the world markets and the US is quite undervalued. Again, historically, when the US dollar has been down, emerging markets have tend to outperform. And especially now that recent data has shown that a lot of emerging market companies are diversifying their revenue streams away from developed markets into their own markets, in their own countries, amongst the emerging markets themselves. And at the same time, again, the narrative of AI and tech, renewable energy in countries like China being developed has been positive tailwinds for the emerging markets. And so we see this a potential opportunity as well.
Now, also globally, we have seen massive spending on infrastructure. Is that, you're seeing opportunity in that space?
Infrastructure for us has been mostly, I guess, a protection on the downside. Again, based on recent data and based on the current geopolitical events, infrastructure has actually outperformed in terms of relative performance to world equities. Reason being is, despite all this going on right now, there's still quite a bit of inflow of capital amongst high quality infrastructure assets. Again, mostly the ones that are relating to AI-driven data centers and infrastructure assets that are linked to renewables. Despite all that, plus the fact that with the stable cash flows and the defensive asset qualities, infrastructure has been again another safe haven asset class for a lot of investors to jump into amongst all the current situation that's happening right now.
And will safe haven plays have been a popular bet, particularly given the geopolitical turmoil that has unfolded, clearly gold being the winner there. Many, though, perhaps forecasting that it may have peaked, or at least it's going to be in a period of consolidation. How are you viewing the precious metal?
Look, we've kind of kept gold at its at about 3 to 5% allocation across most of our portfolios. Just based on current data, central banks are still purchasing gold at a not at a higher rate than it has been the last couple of years. Just the World Council has projected that the central banks will start to accumulate gold for the next 12 months. But again, yes, it has taken a bit of a dip. Could be due to profit taking, due to the fact that the tensions have started to ease a little bit. So safe haven assets has somehow, starting to dissipate, but we're still holding gold, and potentially if there were to be more tension and more volatility to arise in the horizon, gold could still be the positive potential play.